Hello, live from New York City, I'm Scott Sowell from AMVEST Capital. We are glad you could join us today for the webinar with our team from AMVEST TERRADEN. A special thanks to our partners at Coherra for hosting today's webcast. Just a bit of a disclaimer, this webinar is for informational purposes only and does not constitute an offer to sell or the solicitation of an offer to sell or buy any security and should not be relied upon as a basis for investment decisions. AMVEST TERRADEN focuses on companies engaged in exploring, developing, and extracting critical minerals essential for advancing new technologies, crucial for the global transition to decarbonization. These technologies span various sectors such as transportation to energy generation and storage. What sets TERRADEN apart is our unwavering commitment to ESG compliance. We exclusively support companies operating within the Western value chain, ensuring they are not tied to Chinese or Russian interests. This approach aligns with our dedication to sustainability and responsible resourcing. Joining us today are my colleagues at AMVEST TERRADEN, co-founders Stuart Macliver and Tomasz Nadrowski. Stuart is also the co-founder and managing partner of AMVEST Capital, a New York-based specialist investment management and corporate finance firm focused solely on the natural resources sector. With a unique blend of finance and geology expertise, he evaluates natural resource opportunities from both the technical and financial angles. Stuart brings extensive experience in corporate advisory and transactions spanning M&A, equity, and debt capital markets in the natural resources sector. His credentials include a Bachelor of Commerce from the University of Western Australia, membership in the Institute of Chartered Accountants in Australia, and a graduate diploma in geology from the Western Australian School of Mines. Tomasz is a co-founder of AMVEST TERRADEN and the portfolio manager. He is a seasoned expert in mining investments with over 25 years of experience spanning the globe. His professional journey includes roles as portfolio manager, commodity strategist, and commodity analyst at various firms across North America, all the way to London, the Netherlands, and Johannesburg. Tomasz is a former director of the World Economic Forum, holds a CFA charter, and is fluent in an impressive 7 languages. He earned advanced degrees from the School of Economics and Social Sciences and the University of Geneva. Following the formal presentation, we'll open the floor up to questions. We especially value questions from our audience, so please submit yours in the chat box that says Q&A only, and I'll try to ask them on your behalf in real time. And I'll now turn it over to Stuart and Tomasz.
Thanks for that, Scott. So today we'll be discussing the critical minerals sector, covering topics such as repeated failure of capital markets to foster transition, how green is it really, the government's getting in the way or making way, the mystery of the pricing disconnect, and where is the investment opportunity and which risks are identifiable. And Thomas, do we have you there?
Okay, let's
we'll go back to Bill and Vladimir.
Okay, good. As long as you can hear me, that's fine.
Yeah.
We're going to put the subject of critical materials into a broader context. You know, we are mining people, so we thrived through the period of 30 years of globalization, which started in the 1990s. You may remember that the man on the left of that picture quipped famously, "It's the economy, stupid." And this world started crumbling down, I think, around the great financial crisis. Last year came the final nail to the coffin when his interlocutor on the right-hand side replied, "Well, it's security, stupid." And so if we have the thesis and we have the antithesis, then we can also generate the synthesis. The synthesis is economic security. And we're going to speak today about critical materials within this context of economic security. So what is economic security and why does it matter? It matters because it depends who controls the strategic flows. Now, what are the strategic flows? Strategic flows in any capitalist system, the flows of commodities, such as critical materials, but also other goods, services, capital, know-how, human capital, of course, data as well, increasingly. And historically, it's been maritime powers that control the strategic flows, starting from Venice through the Dutch, the British, and eventually US. Russia's not in this camp. It's a continental power. It sort of cares a lot more about stock rather than flow, say stock of territory, like having more territory. But while Russia matters in certain critical materials, for example, nickel, the country that really is of huge importance for this market is China. And China is both a continental and a maritime power. So being both, what has it been doing? It's been actually transforming the flows of strategic, say, capital or other strategic flows into productive capital, into stock of productive capital. And it could do it because it was largely overcapitalized during the period of, let's call it dividend, a demographic dividend between early 2000s and 2019, roughly. So we see that there is a rift between the West and the rest. Very importantly, we pay a lot of attention to the outflows of some strategic flows. You may remember the Chip and Science Act last year, promulgated by Congress. That's control of high-end semiconductors, but also, AI, quantum computing, biotechnology belong to that category. However, at the same time, we have the problem of inflows of strategic flows from China and its partners, and critical materials belong to this category, as do certain pharmaceuticals or APIs, as we learned during COVID, as well as nuclear services, not least conversion and enrichment. So you might say, well, who cares? Capital markets will somehow arbitrage that difference and deal with that rift in the middle. Well, yes and no, because we've seen already for a couple of years that things are a little more complex. You'll see in a moment that there are cycles in critical materials, and these cycles tend to be quite volatile. I used to manage a critical materials portfolio of mining equities for a family office, and that sub-portfolio did very well in 2016, 2017. And at the end of 2017, I sold that portfolio. What happened subsequently during the next 2 years, 2018 and 2019, was a complete abandonment of this sector by providers of Western capital. So there's we saw it with the fall of the prices, lithium and rare earths and graphite and other critical materials. Some people were saying, well, lithium was just a bubble, or rare earths are not so rare. So there were analysts who were actually laughing off this entire sector. And of course, the Chinese were laughing too, but for a different reason. They could deploy capital during this period and pick up large numbers of vital sources of supply around the world, not least in Africa and in South America. Now, that led to a situation where of all the companies, say lithium companies that were put on the block since 2018, about 50% were acquired by Chinese companies. And that followed a national policy in China called National Mineral Resources Plan, which was introduced in 2016. So 6 years before Inflation Reduction Act in the US, and 6 years before Critical Minerals Plan introduced by the EU last year. So you see here at the bottom, the downside here, the drought drift in 2018, 2019, and little of that prepared the Western capital allocators for the upswing that resulted from essentially huge demand for electric vehicles that really started in the first year of COVID in 2020. So the question is, why did Western capital allocators miss out on that opportunity? And I think there are three ways to answer this question. First, in these minerals, unlike, say, in a copper mine or a gold mine, it's really not possible to hedge your exposure to the underlying commodity if you're involved, say, in project financing, which you can easily do in the futures market. In copper, you can force your gold company to hedge gold price on the contango. Here it's not possible, so it increases the risk for capital providers. The second reason maybe is that seeing these cycles, the allocators didn't really see the structural shift that was taking place at that time. And it's important to compare the lithium market, which at that time, 2020, was worth about $1.5 billion. And today it's $20 billion at pretty low prices of lithium. And we can compare it to iron ore. Iron ore at the turn of the century was $5.5 billion worth of global market seaborne iron ore trade. It's right before COVID, 400 billion, right? So 67 time increase. So this somehow was missed. And the other reason might be the geographic reason. The view was, well, we don't need to really invest in these things because we can always buy these critical materials from China, which dominates much of mining and the bulk of refining, separation, and processing of these minerals. So we can just purchase it for them and then build our own battery materials. That would be okay were it not for a strategic decision by China to actually promote the end product, the retail market, and the electric vehicles. So that's what we're seeing in the market. That's what the European Union noticed at the latest, I think, this last summer, as Chinese high-quality electric vehicles started creeping into the European vehicle market. So the capital providers simply did not notice that there would be scarcity value in the West if, by any chance, the access to those minerals could be constrained. And it is constrained. It is constrained because China has a law called Export Control Law introduced in 2020 and occasionally uses elements of this law, not least 10 days ago, in graphite market, where China announced that it would simply not allow for unbridled, unchecked, uncontrolled exports of graphite. Similar announcements came earlier for germanium and gallium and for technology for processing of rare earths early this year. So it's important to pay attention to two tensions in this market. One is the vertical tension within the value chain, where there is almost $400 billion that's gone into gigafactories versus 5 or 6 billion that goes every year into mining. So definitely not a sustainable tension there. And the second one is the horizontal, geographic the imbalance between huge control that China has over most of these minerals, especially midstream, and to some extent in mining as well, and sort of deindustrialized West trying to catch up. It's difficult because while it's fairly easy to build a gigafactory, it takes between 12, 18 months, in China probably 6 months to build a gigafactory. To build a mine, it will take you, if you're lucky, 7 years, sometimes 10. For a larger copper mine or nickel mine, 15 or 17 years. So it's unlikely to see this tension being resolved anytime soon. Now, often the question we get is whether this investment is green, whether it's environmentally correct to move from fossil fuels to minerals, and it really depends on how you do this. So if you're driving a Tesla with Chinese-made LFP batteries, so lithium iron ore phosphate, most of what's inside this battery is not recyclable because it's very difficult to recycle lithium. There are attempts to do this, but they're very, very limited right now. So you may say, well, my car has NCM battery. An NCM battery contains nickel, cobalt, and manganese. The problem is if that battery is made through the Chinese supply chain, then chances are that your nickel is sourced from under the last remaining rainforest in Sulawesi in Indonesia. Your manganese is sourced from Gabon, where Chinese companies shift the course of rivers in a perfect way, as Nikita Khrushchev used to do it in the USSR with known consequences. And cobalt is never far away from allegations of child labor in the DRC. And so let's assume that that battery made in China was actually made according to the highest standards, environmental and social standards. Well, even so, it was made in China. And that means it was made with what? It was made with coal. Because 70% of energy endowment in China is coal. And since they add about 100 gigawatts every year, so in 2 years they add as much as US has across the country of all the coal power generation, and even more so than Europe, which has 188 gigawatts of coal power left, well, that proportion is not going to change. So if you drive this electric car in China, what you eventually do is basically you switched over from gasoline to coal, kind of self-defeating if the objective of electrification is decarbonization. But it's possible to do it right, and it's possible to, of course, do mining and processing outside China. But unfortunately, our government has failed historically. It's very difficult to take this off the ground in the jurisdictions of the United States, depending on the state, but timelines are very long. And as I said, timelines for mining are elongated by definition. The speed really matters. Speed matters for competition. That's why it's so vital for the US to cooperate with other countries, not least with Australia. And the Prime Minister of Australia was here last year in Washington discussing precisely this issue with Gina Raimondo and with President Biden, but also with Canada, which is another country with very developed mining industry, with Japan and Korea, which are important competitors to China in the battery manufacturing stage of the value chain, as well as Europe, which is still the largest trading bloc, and maybe other countries that could join, such as Brazil, for example. One thing, of course, that all investors in mining ask for is the commodity prices. And unfortunately, in this market, it's not like in copper and wheat and oil that you can go online and check what the price of a given commodity is and then extrapolate this, what it means for a specific producer. That's because, well, it's complicated. What's really used in the value chain are chemicals made of the ore generated by the mining producers. And that's why it's important to be able to distinguish between prices of nickel metal and nickel chemicals, between lithium carbonate and lithium hydroxide, for example, and the spread between those different prices that will depend on the relative demand of different types of and different chemistries in the batteries that are produced. And we have to add to this, unfortunately, a certain opacity of the price discovery, as many of these markets are either completely dominated by China or controlled 100%. There is no price of rare earths outside of China right now. And that leads to a situation where it's not only opaque, but it's also kind of lends itself to manipulation. We've seen it recently in the lithium market. So let's say this year, electric vehicle sales globally are up by about 38%. So you could expect the lithium prices to do fairly well. Well, not necessarily. Lithium prices are right now 1/4 what they were a year ago. And we know that the market is hot because South Korean refiners are selling product to battery producers in China. So, with every car containing between 35 and 85 kilograms of lithium, depending on how big the battery pack, these prices should be fairly strong, but they're not. And it's no different in other critical materials right now. That's partly due to overcapacity in China, midstream and downstream. China's demand for electric vehicles, about 7.5 million units a year, but its productive capacity across 200 different producers of electric vehicles is 15 million. So twice as large. And it's even worse at the battery manufacturer level, where that overcapacity is 4 times as large. So this is a problem, especially in the midstream, because like in other commodities, the midstream is when you find very, very tight margins. So margins are usually high at the mining level and very high at the producer level, so the retail product level, in this case, electric vehicles, but they're very tight at the refining sort of midstream stage. And so it means that you have overcapacity of companies producing too much of the stuff that's not priced very well. And that, of course, means that there are different schemes to, in a way, reduce the prices of the upstream feed into battery manufacturing within China by, for example, moving the weight from more visible spot market to the term market, or by simply, as I was told by the largest Western rare earth company last week, by directing the producers of rare earths to set a price X in kind of a classic Soviet way. But that result of that is, of course, the prices of these chemicals are higher outside of the Chinese value chain and lower in China proper, thus increasing the competitiveness of the Chinese products. But at the same time, it reduces the economic rationale for mining producers outside of China. Because, for example, before building the first concentrate, the mining producer would like to sell unprocessed ore in order to gain some early cash flow. And right now, it's just not economic to do it or to ship it. So the prices of these materials, such as you see here, the lithium carbonate prices, are too low currently as an incentive price for new investment, adding to the tightness that we'll see with very, very strong demand and unfortunately the supply that just barely can catch up. So how do you translate that into an investment opportunity in mining? Well, generally, you can categorize mining equities as falling into three different categories. There are mining operators, miners that generate cash flow, have operating mines, and it's really up to them to catch these cycles, like you see here, at the right time. They have a choice between greenfields, exploration, new areas, brownfields exploration around their existing mines, or M&A. And there are many cycles that determine what is more economic, doing more M&A or more exploration. But essentially, the timing is theirs. But the two other groups, that are the developers and the explorers, are kind of cycle takers, if you wish. So they're exposed to the cycles. The developers are those companies that have done a lot of technical work. They've done the permitting work. What they're still faced with is financing and construction. And especially high interest rates, it's a very, very difficult place to be. And so they tend to be punished at that time in the cycle. The third group, the explorers. The explorers are early stage. They found something. They have produced some data with geochemistry and geophysical studies. They identify the targets, they drill them out, often produce their first resource, and are advancing slowly to become developers. But they are further away from that capital expenditure. So then looking at these three categories, the producers, the developers, and the explorers, that we can still subdivide into pre-resource explorers and explorers with resource, we would normally expect the value attached to them to depend entirely on how far away they are from cash flow, right? As you can see on this slide. So producers, cash flow producing, cash flow generating, developers a little further away, and explorers very far. But that's not what happens, because you have to factor in where we are in the interest rate cycle. So in fact, the developers are those that are now most punished because they have to vie for attention of capital providers at a time where capital is expensive. And this happens in a structurally transformed industry because this is a new sector. And therefore, they have to find sometimes multilateral banks, sometimes export credit agencies, sometimes development financial institutions that would back them up, because commercial banks are not comfortable. They're certainly not comfortable with a counterparty risk in China if these are the clients of these companies. So the result is that if you run a portfolio in critical materials after, say, 18 months of that trajectory interest rates, it ends up being kind of a barbell portfolio, heavy on cash flow and heavy on explorers, and much less exposure to developers. So in this space, what is that we actually like? Well, there are various ways to look at it. It's good to run a portfolio that's diversified across different commodities, and each commodity may be sourced from different types of geology. We certainly like large pegmatitic lithium, hard rock lithium. So these are igneous rocks, intrusive igneous rocks with large crystals, such as you find in Quebec or in Minas Gerais in Brazil. Both jurisdictions, by the way, very good because they offer a lot of hydropower. Quebec has 38 gigawatt of hydropower, Minas Gerais 26. So some of this could be allocated to the future production. The second category is in rare earths. We like ionic adsorption clays. This is where rare earths were weathered in a laterite and then absorbed into clays. It's fairly easy to dig, a cheaper operation, and provided it can be controlled with controlled vat leaching rather than what China used to do historically, just basically sprinkle in situ leaching with damaging consequences for environment. Carbonatites, which are alkaline plutonic events, they're very good sources of also rare earths, and niobium, which potentially could be an important critical material if there are changes to the technology in battery anode. Then we have igneous phosphate deposit. Phosphate is important, high purity phosphate for batteries, the LFP batteries, the lithium iron phosphate batteries. And finally, high purity manganese, especially if there are carbonates with supergene, but outside Gabon, it's a little difficult to find it. We are more cautious about some other commodities. Graphite, for example, although this market might become a little tighter now, given the announcements from China, export curbs potentially. Also nickel and cobalt, a little weaker at the moment. as is vanadium, which is a source of certain type of storage batteries. So, and it's important to pay attention to jurisdiction. But, you know, although there are fantastic opportunities, and really often you see very quickly 5, 8, 10 baggers in this space, which is very exciting. It's recently happening really more in the exploration area, and often among the Australian listed companies. It's important to pay attention to a number of risks here. And so I would say number one risk is a risk of technological substitution. With the possible exception of lithium, which is there to stay for a lot longer, most of the other commodities are subject to some kind of risk of substitution, either because of their high prices or their high volatility of prices, or because simply of technological progress, and as well as this rift between the West and the rest, and the risks to supply of those strategic flows. That could also accelerate technological development. But you know, technological breakthrough and commercialization are two different things. So we still usually have a lot of time to see that. But here's an example of a company, and pay attention to those bars at the bottom because they illustrate the volume over the trading period. So you see what happens on the day of a massive blowout in this particular case. Here, the risk is jurisdictional risk. So we tend to think of jurisdictional risk as sort of a creeping expropriation, right? You go to Chile and President Boric decides, well, let's just nationalize this thing yet again, right? 50 years after the experience for the first time. Or, you know, the president of Colombia or some other governments that are kind of left-leaning could go in this direction. But this is also a question how an invested company interacts with its host government. In this case, this company is in Mali, has a Chinese partner. And I find this particularly interesting case because my previous mining company worked in Mali and worked in Mali successfully for 20 years. And my CEO used to say, well, in these countries, you give them free carry, what they ask for, and then something else, extra premium, to lock it in for a long period of time. And on day one, investors won't like it, but in the longer term, they will, to avoid precisely this event. What was the event? Well, that company was trying to sell a product, a pre-processed product, without being taxed for it because, you know, they exploited some fine print in the contract, basically telling the government, well, you didn't sign on that, so we're going to do this. Well, the result is, of course, they're not allowed to export anything now. So it's jurisdictional risk is important, especially how companies manage that jurisdictional risk. Another example is the chemistry. This is chemically complex type of deposit, especially when it comes to lower grade deposit. Here is the case of what we call DLE, so direct lithium extraction that's used for lower grade deposits. There are three major technologies that are used, but often they're kind of black box. And this is the case of this particular company. The day it dropped, again, on those huge volumes, as you see, the company announced that unfortunately the technology in this lithium project, DLE lithium project, the development will take about 6 years more than previously thought. And so, of course, you see the catastrophic result here. Another source of risk is just basic metallurgy. Here we have a company that was a darling of the Australian market for a long time because its exploration projected a very, very large, successful, potentially successful mining operation because of its size, because of its strike, because of its width, because of its depth, because of its grade and its specific gravity. So you can quickly do your numbers and find out, well, this is really interesting. The problem with this, however, it's a multi-metallic project with several PGMs, with nickel, with copper, and so on. And so this story is really in the recovery. And when the first numbers for the recovery, I mean, the metallurgical recovery was much, much lower than what was expected, that of course affects hugely your projection of the NPV. So it's good to pay attention to some precedents. If you're going to some company, which, for example, has a plurimetallic deposit, a deposit with deleterious materials, or with other byproducts that cannot be easily monetized. So that's another example. And again, you see those volumes that simply might prevent you from exiting this position when this unfortunate event happens, and this sort of announcement. On the other hand, if you just invest in exploration companies, often you can preempt sort of more disappointing inflow of information. This is a case from Canada this year in a remote part of Ontario, and we really we saw that the data were not forthcoming as much as the company was promising. So most of the time you had the opportunity to set your stop losses in the market and decide, well, okay, it's gone too far, and you'd be able to get out even with a sizable position. So different type of risk, more easily manageable from the trading perspective. But of course, in order to understand these risks, you have to get to know the companies. You have to know who is who, and my partner Stuart Macliver knows just about every person in Perth and every other person in Vancouver. It's important to know because there are a lot of self-promoters, as we know from Greek mythology. King Midas. Today, everybody claims to be Midas, and Midas famously, everything that he touched turned into 2% lithium. And so we have to be careful with those self-promoters. We have to know not only what is what, but also who is who. And for that, it's important to also travel to these places and to see those mines, and really talk to the operating management and find out what's really hiding there. So maybe, Stuart, you can just reminisce about your most recent trip to Brazil.
Yes, thanks for that. And so went to Brazil about a month ago, and there I saw one lithium mine, 2 lithium projects, and 1 rare earth project. So the bottom left corner, that's a stockpile of lithium spodumene concentrate, 6% grade, and that gets shipped from Brazil. Their only customers are in China. That company hasn't diversified into the West. And the bottom right, you'll see that's at a rare earth project in Brazil, big ionic absorption clay deposit. Top left, that's me holding the drilling core of lithium projects, a hard rock pegmatite. And then to the right, you can see the geologist in the yellow top and blue pants. He was showing us how he discovered the initial lithium vein there. And it's important to go to these projects to see a few factors. 1, logistics, how easy or hard is it to get there? The community, how well these companies are looking after the community that they are operating in, whether locals can have job opportunities, whether they want those opportunities and want to see the project get further advanced, and seeing how senior management operate with people on the ground is important, and seeing how well run their operation is in terms of safety, coordination with other stakeholders as well. So yeah, in conclusion, Tomasz, you want to finish?
Yeah, so just a very quick conclusion. I think it's important looking at this market to maybe obsess less about where the current price is of the commodities and look at it from perspective, okay, what are the strategic flows that are changing in the world? And this definitely is, in addition to semiconductors and others, one of those sectors. And second question is, okay, so if there is a structural change that this sector is undergoing, where are we in the cycle? And so it just happens that in this sector, currently, we are both at the cusp of a structural change, the beginning of that long journey that I illustrated with the iron ore market before, but at the same time, we're at the bottom of the mini cycle. For, I think, 18 months right now, this market has been going down. So you have a double whammy and high required rates of return are certainly there if you time it right. So that's the question, how do you time it? And my view is, because this is not fracking, this is not short duration, this is long duration, that's what mining is, we have to wait for the signal in the interest rate environment. And, just like long and treasuries with positive convexity, they'll flip easily once we have a visibility for interest rates to stabilize and then maybe start going down. So let's hope at some point in 2024. So that concludes this part.
Great, thank you so much. That was so insightful and interesting. We'll now move on to Q&A. So we'd again love to hear from our audience. So if you have any questions for our team, please submit them and I'll ask them. Maybe to kick things off, a question that I have is, what defines the investable universe within the critical minerals sector?
Thanks for that. So around the world, probably 80% of the world's mining projects or mines themselves would be owned by public companies. And of those public companies, about 40% would be listed in Canada, and then about 30% listed in Australia, and the balance listed in London, some Hong Kong, and a small amount listed in the US. So, you know, the nature of the sector is a lot of those companies are headquartered in Vancouver, Canada, listed on the Canadian Stock Exchange, or headquartered in Perth, Australia, listed on the Australian Stock Exchange. So for American investors, it is hard to get exposure to these companies given where they're listed.
Great, thanks. How do investments in the market tend to fare in terms of risk and
Yes, I'll just move back to this slide of the kind of investable universe and the life cycle of a mining project. So far left, you know, on the x-axis, you'll see the stage of the project. The y-axis, you'll see the change in value post-discovery of a new project. You know, earlier stage, you know, they'll be using geochemistry, geophysics, then drilling. You know, we wouldn't be looking at a company until they've made a discovery, and you can see the shaded section, which has our investable universe. And then, you know, from here to mine, from discovery to mining, it could be anywhere between 7 and 15 years. Multiple factors can come to that, being, you know, availability of staff and drilling, how the ore body is defined and how much drilling is needed, the jurisdiction it's located in, and how easy it is to permit. I was in Brazil recently, and they have streamlined their permitting process. So some companies can get permits within a year. If that was in the US, you know, it could be 5 years for permitting, could be 10 years for permitting. So that can depend. And then other factors that can impact this are management's ability to secure finance. And in this kind of orphan period we see on the curve, you know, sometimes that can be a period of, you know, less excitement for the market, and can either be a challenge or a positive for some companies to overcome this section, and then leading to the operational mine. From when companies get their construction finance and their permit, it can be anywhere between 12 months to 36 months from mine construction to first cash flows.
Thanks. I'm curious if you can tell us sort of who the key players in the major companies are driving the sector.
Yeah, so maybe I'll address that. There are essentially three main markets where large companies are. So strangely not Canada. Canada has been quite open in its history of mining, selling its jewels to other operators, whether in the UK or in Brazil. So those three centers are companies in New York, companies in Australia, and companies in Hong Kong/Shanghai. In the US, the largest company is Albemarle, a chemical company. Tragically, this year, one of the 10 worst performing members of S&P 500. Another company is Livent, with important projects in South America, and also merging with, I think, second largest lithium producer in Australia called Allkem. There is, in Australia, the largest operator is Pilbara Minerals, very successful, historically selling mostly to the Chinese market, as well as the aforementioned Allkem. And a number of others. Mineral Resources is an important player, although they have also iron ore resources. Independence Group in Australia, which used to be just a nickel gold company, now also a lithium producer. And in China, there are a number of companies. They also are invested outside of China. One of them is Tianqi Liyue, which is invested both in Australia and in Chile historically, going Ganfeng Lithium, another very active on M&A trail Chinese company, Shanghai Resources in rare earths, and Zhejiang Huayou in cobalt space. So these, I would say, they're the most important ones. As I said, we do not invest in any companies that have either equity, credit, or offtake in China, much less into companies listed in China.
Thank you for that. I'm curious, as technologies inevitably change over time, how does the critical minerals industry strategize and adapt in response to these shifts? For example, the automotive industry's decreasing reliance on batteries and magnets.
Yeah, so all of the technological advancement is playing alongside. So it's not like we have the commercialization of these batteries and nothing's happening in parallel. But there's a difference between a lab and a pilot plant and demonstration plant and the actual commercialization in the context of one project, much less in the context of the entire infrastructure of the entire country. So I'd say that it's fascinating to read, and we read every week what happens, whether on cathode side, on the anode side, or on the electrolyte side. All of the non-conventional technologies have still quite some time to go. So our view is that probably this decade we are in the hands of Teslas and BYDs and CATLs and those companies, but it will change. I was recently in Japan at Toyota's headquarters in Nagoya and had discussions on that, and they definitely are thinking about the next stage. Probably not gonna change the world before 2030, but at some point it might, because there are serious companies seriously working on that, and especially Japan, which potentially has access to methane hydrate offshore. Hydrogen future might still be ours, but it doesn't prevent us, of course, from investing right now in this particular value chain as it looks right now, because this infrastructure for electrification is still being deployed with some delay in the West. So yes, it's important to look at it. It's important to run a portfolio that's diversified between different commodities. I do expect some changes to anode chemistry if the rift with China continues on the back of that announcement regarding graphite 10 days ago, and it could also affect other commodities. So that's definitely something that needs to be watched. But we definitely are, for a couple of years, in the kind of world of growing sales of electric vehicles as we know them now.
So while recycling, of course, plays a crucial role, what are the enduring reasons for continued investment and exploration in mining critical minerals?
Yeah, so I often get that question from people who care about environment. And so they care about electrification and decarbonization. And I'm always very sad that I have to disabuse them and tell them that, what? There's not going to be decarbonization without mining for a while. So International Energy Agency looked at what recycling, with its improving technologies in recycling, could do to help us with the supply through the secondary loop. And while they see about 10 to 12% of the entire supply being sourced from the secondary loop from recycling by 2040, that's only 10 or 12%. That's still more than there was lithium sold overall in 2020. So it's a large number in absolute terms, but in relative terms, it just illustrates that mining is there to stay for as long as we need minerals. And unfortunately, these technologies are very mineral intensive. Recycling has to deal with very complex chemical issues. Let's not forget it's inorganic chemistry, which was completely orphaned by the capital market, which went towards biotechnology and everything that's organic for decades. And so we're slow coming up with solutions. And you see, unfortunately, that the recycling companies that are listed have had a terrible year. 50% down for Aqua Metals or Recyclico, and Li-Cycle had to actually abandon its construction last year. Construction stage company, realizing that the economics is not there. Low prices of the commodities, as we see right now in the cycle, are bad enough for mining. They're very bad for recyclers, because recyclers have to have volume and they have to have somewhat higher prices than we have right now. So that slows down actually this process. Hopefully one day it will be there. I'm all for cyclical, full cycle economy, but we're far away. And what the industry, metallurgy, brought as a legacy into critical materials is mostly pyrometallurgy, so burning essentially, nickel, cobalt, and copper. And these are the only three metals where you see a significant contribution from recycling into the value chain, not the light metals like lithium. That's very, very difficult to do.
Great. I'm also curious what you guys think are sort of the emerging markets or regions with the most untapped potential in this area, and what challenges or opportunities does that present?
So we're going through phases of interest. For a long time, if we look at just lithium, right? For a long time, the country of reference was Chile, with its significant brine production. This then shifted, the interest shifted to different type of geology, mostly hard rock lithium production in Australia, more recently Quebec, and now Brazil. Africa, of course, is very richly endowed, but the problem is that Africa, during those periods of downdrift in the market, is the game plan of Chinese operators. So it's very much in the hands of Chinese miners. There are opportunities. There are untapped opportunities in West Africa. One London-listed company in Ghana, very, very early stage developers in Cote d'Ivoire. Mali is there as well. The DRC, of course. There are opportunities in manganese production in Botswana, in ionic clays and rare earths in Uganda. There are opportunities in graphite in Tanzania and Mozambique. So Africa is very, very well endowed. Morocco as well, with phosphate and cobalt. So some of these are more advanced as coming from, say, legacy mining in other products, in other commodities that were hotter historically, like copper, for example, or gold. But some others are actually fairly new on the learning curve, and that also slows down the process. The fact of the matter is the competition from Chinese operators is very strong. Chinese own as much land as basically making them the third largest nation in Africa after Algeria and Democratic Republic of Congo. So it's places like Zimbabwe and the Chinese miners completely 100% control the access to critical minerals right now. So it depends. Some countries are more open to that more long-term prospect. The US signed MOUs with Zambia and DRC recently, promising also industrialization of the value chain. So not stopping at the mine gate, but also developing in the value further down the value chain. And Ursula von der Leyen, the commissioner, the head of the Commission of EU, recently in a speech in the Philippines, she adopted exactly the same language, that we Europeans are here to invest, not only just to rape your commodities, but to develop the industrial part, which is what Indonesia has tried to do over the last decade, I'd say. But as a result, they initially attracted mostly Chinese capital.
Interesting. We have a question here from Maria. She's asking that in the institutional blockchain space, there's a growing trend toward tokenizing real-world assets, such as real estate, commodities, and equity. Have you had a chance to explore this, and what's the industry's stance on it? How do you envision it impacting our investment landscape?
So this is a very hopeful thing, right? That we would be able to, say, buy an EV and touch it, and the blockchain will tell us where each molecule came from. I think we kind of far away from this, because the process of checking that would have to be third-party resolved at each node of the value chain. Why is that? Well, because unfortunately, currently, the value chain almost inevitably in some of these critical materials transits through China. Just to illustrate, 50% of global nickel processing happens in China. 70% of global cobalt happens in China. 75% of lithium refining happens in China. For light rare earths, it's 90%, and for heavy rare earths, it's 100%. And so, yes, maybe if we were to do a complete COCOM, just to remind you, COCOM was that Cold War entity that controlled the flows entirely, so that nothing of value leaves for the USSR, which is unlikely to happen in the New World. It's going to be very difficult. I'm hopeful because it would solve the issue. I know that the diamond industry looked at it for a long period of time. It's more complicated in metals which are fungible, because a bar of gold is a bar of gold. If you have half of this from this side of the Zambia-Zimbabwe border and half of this from this side of the Zambia border, what do you allocate it to? So it's a complicated matter, but I think some value chains in mining and processing are more advanced than others. Here, I think we have a problem of just generally lack of transparency in the value chain because it's not controlled by the Western operators entirely. I don't know, Stuart, you want to add something to it?
Oh, yeah.
Yeah, I think it's just at this stage, tracing from mine to final product, whether it's in a car or a phone, is tough presently, given where things are processed in mainly in China. It'd have to have a global adoption of countries for this. So perhaps a third-party body could come together to bring countries, in kind of like a UN type outfit, or countries doing something like the Paris Accord, coming together to have a tracing element of where products come from. But yeah, I think we're far off.
Thanks for that. One time for one last question before we start wrapping up. How do advancements in extraction and processing influence economies of critical minerals?
Advances in terms of technological advances.
Yeah. Mm-hmm.
Yeah. So the very positive thing happens on the environmental side because there are new technologies. Let's say, for example, fleets. Right. There's a lot of vehicles in mines, whether open pit mines or underground mines. It's now increasingly possible to replace those diesel vehicles with electric vehicles. And that's now for a couple of years. It started with certain pilots, and it's a huge change, right? So making those mines, basically leaving them a much lower environmental footprint. New technologies that are less carbon intensive. Sometimes you have to sort of default to certain types of geologies for this to be easier to operate. Definitely a closed water circuit or mining without generating wet tailings. It's another good reason to be happy about the developments in mining. So yes, I think mining generally is evolving in this direction, but it's really possible mostly for new operations. The old operations, it's sometimes very, very costly, very difficult to change entirely, and especially if you think about an underground mine, which has, drifts of certain size, let's say corridors of certain size, or tunnels, let's call them. And, the equipment that goes in there is of certain size. It was built this way and maybe a little difficult. But overall, mining is absolutely critical. And I think if we think going forward, especially in the decarbonization area, an electric vehicle is 8 times more intensive in minerals than a classical ICE vehicle, internal combustion engine vehicle. And if you look at, say, wind power versus gas turbine, that's 9 times more. So wind power uses 9 times more minerals than a classical gas turbine. So from that perspective, I think mineral mining is definitely a big contributor to acceleration of the new electrification in our economies. In terms of employment, I'd say less so. So that's usually a source of disappointment in the country's emerging markets or frontier markets. Hence that narrative that the Western countries have adopted. Okay, you have those, geological endowment. We'll help you build downstream rather than just take your resources like China does into the into the supply chain in a developed country.
Yeah, I think I'll add to that. Depending where the mine is located, I know, say in Brazil, 85% of Brazil's grid power comes from renewables, mainly hydro, followed by wind and solar. And so for new mine, and in Quebec in Canada, and so for new mines to get on stream in those jurisdictions, they can tap into that hydro power. Compare that to, say, a lithium mine in Western Australia that's quite remote. There's no grid power connection. So to get those projects off the ground, they're using diesel generators. And it's not until they've had initial cash flows they could then install, say, a solar panel grid or solar farm, which would then reduce their energy costs and also increase how environmentally sound their operation is. And I think in the US, which is typically not very forward or at front of mind with upstream, is very good at downstream, and the US is investing a lot of money into downstream processing technologies. Direct lithium extraction was one we discussed. A lot of those companies are based in the US and have lots of funding from USBC type outfits. But I think as newer mines come on, they will utilize newer technologies, newer processes, high environmental standards, versus some of the historical legacy mines, we need to either upgrade or be kind of mined out. And so, Scott, I think we should, head to the closing.
Let's any sort of one line final takeaway from both of you on most important key point before we finish.
Yeah, I really think that the combination of the structural shift, the tightness in the market, and the cyclical low that we're observing currently in the prices of the listed proxies really invites you to look at this with some interest over the next couple of months, as things will most likely pick up with the interest rate changes. So it's really worth doing a little bit of homework on this sector now.
I think for me, as Tomasz has said, there is no decarbonization without mining, and people need to focus on the upstream aspects of the energy transition, and mining can be done to high standards. Countries like Australia and Canada have exhibited that. So other countries should learn from those kind of rules and standards, and adhere to doing things properly.
Well, great. Well, thank you once again to Stuart, Tomasz, and our partners at Coherra, as well as to everyone who joined us today. As I mentioned previously, a copy of today's presentation is available for download, and the last page of that deck, you'll find contact information for us at AMVEST TERRADEN, and so we'd love to hear from you. So please reach out, and if you want to learn more about what we're doing. Again, thank you, and farewell.
Thank you.
Thank you.